Can you guys hear me? You can use the chat to respond. Okay, okay. Great, great. All right, so let me share my chat with you so that you can see my screen. Um, First, before I share my chart, let me quickly do a brief explanation or a brief introduction to the concept of smart money concept. Um, Basically, smart money concept allows you to um, anticipate market movement. Okay, it gives a reason for everything that price does. Okay, I'm proud to when I understood smart money concept. Um, like I mentioned on the group page, I was trading with indicators, stochastic oscillators, MACD, RSI, oversold, overbought, and a bunch of other indicators like that. And oftentimes you just rely on what the indicator tells you. Okay, it tells you RSI, for example, will tell you that okay, if RSI is above certain level, that's when you want to sell. If RSI is below certain level, that's when you want to buy. Okay, and oftentimes you buy and then you realize that the market goes against you. And looking at chart patterns as well, double tops, head and shoulders, and so on and so forth. Okay, you place your order, you think that you've seen a perfect, clear cut pattern, and you place your order there, and then before you know it, it stops you out and then continues to go in the direction that you were anticipating. But it has already stopped you out before it started moving. Okay, those were things I experienced, and one of the things that helped me discover the flaws in indicators and chart pattern is the fact that I document my trades. Okay, I document all my trades, and I oftentimes I go through them. So I have a very rich journal, and I go through them trying to understand what could have gone wrong each time I have a losing trade. Okay, in fact, for a long time, for a while, I stopped using stop loss. Like I stopped using stop loss since most of the time my stop loss would get hit and then price will still continue to move in the direction that I was anticipating. Okay, so I stopped using stop loss. The trade will go bad for a while. I'll be underwater for a while and then eventually it will end in profit. Okay, that was where I was trading for a while. But then the implication of that is that I have to stay on the chart to monitor the chart. You can't sleep. You can't have a trade without stop loss and then you'll be able to sleep. You won't know what is going on and all of that. So I didn't enjoy it. I didn't like it, and I was on a quest to try to understand how why does market what it does? Why is it that those chart patterns don't play out? Why is it that those indicators oftentimes are not very reliable? All right, and it was in my quest for understanding. I started studying order flow. Okay, order flow, volume profile. I tried to understand market footprint. Okay, these are actual charts. Okay, these are actual charts that you can actually see and study. It's not available on TradingView. Okay, but when you use professional trading platform like ExoChart, you would actually be able to see exactly what is going on, where large orders are being placed, where there is price imbalances. You would see them. Okay, you would actually see them on the chart. Okay, the actual volume, the volume of orders, delta accumulations, market depth, all those things. Okay, you see them. You don't need to bother too much about that. Okay, but if that's why I gave you link to understand market profile, volume profile, market footprint, delta imbalance, all those things. I wouldn't be talking about them at all because eventually you wouldn't be using them on the chart when it comes to smart money concept. But when you actually understand that, you would be able to know the theory behind smart money concepts. Like when you talk about price imbalances, like what does it actually mean? Okay, on Exo chart you can see it. You can see those price imbalances. You can see when we are talking about order blocks, demand and supply zones. You can see them on the chart. You can see the volume of buy and sell orders. You can see where people place stop loss and the huge amount of orders that are actually in those places. So that was where I started from. Okay, so to some extent, I understood the whole concept of liquidity, the concept of um, price imbalances and all of that before I actually even started studying smart money concept. All right. So if you want to understand what is happening in the background, okay, what is happening in the background where there is a lot of liquidity, where people are getting liquidated, you might want to check out that link I provided on the group page. Trading Riot. Okay, Trading Riot. There's a lot of articles on market footprint, market profile, volume profile, delta imbalances, cumulative delta, and all of that. Those are the maths behind. That's like the maths, the theory behind smart money concepts. All right. So if you study it in depth and you understand it, a lot of the things I've been saying will make a lot more sense. But you don't need it. That's true. I don't use it to trade. Okay, I don't use it at all to trade. So you would still understand smart money concept and be able to use it even if you don't study all of those things. Okay, there are people that trade just based on that. Okay, but I don't use it to trade at all. I trade purely based on what I see on the chart, the candlesticks and all of that. So let me share my chat my screen with you so that I can just jump straight in into um, understanding market structure. Can give me a minute. Let me. mm, Come in. Okay. Can you see my chat? Can you see my screen?
Yes, we could.
Okay, great. So when you talk about market structure, um, when you talk about market structure, there are three types of market structure. Okay, in any market, price is either bullish, bearish, or in a range. Okay, in a bullish market, price is constantly making higher highs, higher lows, higher highs, higher, as you can see here, higher highs, higher lows, higher highs, higher lows, higher highs. Okay, so when price goes up, makes a swing high, this is a high, it retraces, and takes another leg up, retraces, takes another leg up, retraces, takes another leg up. The high that forms each time it moves up is a higher high. The low that forms each time it retraces is a lower low. Okay, so higher high, higher low, higher high, higher low, higher high, higher low, and so on and so forth. This kind of structure is a bullish market structure. Okay, so price is constantly making series of higher highs and higher lows. So when you see this, of course, on the chart, it's not going to be this clear, like it's not going to be this vivid. Okay, you get confused sometimes when you look at the chart. I will show you examples. Okay, and bearish market structure, price is coming down. That's essentially what you need to know. Price is coming down, making series of lower high, lower low. So price drops, retraces upward, drops again, retraces upward, drops again, retraces upward, drops again. Okay, so this kind of structure is what you call a bearish market structure or a downtrend. So this is uptrend, this is downtrend, right? And for a range, price is essentially consolidating, like going up and down, going up and down, going up and down. It's not breaking above the previous high. Sometimes to break above the high and still drop back again, more like a market structure that is not well defined. So price is just ranging, moving within a range, essentially forming equal highs, equal lows. Okay, something like this. That's a range. Okay, and now one thing you should know is that oftentimes when price makes a strong bullish um uptrend, okay, the first thing that happens after is that price forms a range. Okay, so price will range for a while before it then shifts structure to downtrend a lot of times, especially on the lower time frame. Right, and same thing applies to a downtrend as well. Okay, now each time, like I said, each time a swing high is formed, price retraces and then moves up again. All right. Now, the point at which price goes above the point at which price goes above the previous high. So the point at which price goes above the previous high is where we say a market structure break has happened. Okay, so when price goes above this higher high, market structure break has happened. When price goes above this higher high, market structure break has happened. Okay, and in the same way, each time price forms a low, it retraces and then breaks the previous low. Okay, the most recent low. Okay, here now this is market structure break. This is market structure break. This is market structure break. All right. So I believe that is very simple. Okay, market structure in this is very simple. Now let's look at the concept of strong highs and strong lows, weak highs and weak lows. Okay. Now in an uptrend, price is going up. Okay, you don't want price to come down. All right, price is going up. You don't want price to come down. Okay, the market makers want to drive price upward. Okay, they don't want price to come down. Now, the way market makers place their orders, okay, let me quickly do a quick explanation on market makers. Okay, oftentimes when you hear about market makers, um you think that okay, there are bad people with huge amount of money that are manipulating the market, but it's not really so. Okay, market makers, what they basically do is they are paid. Okay, they are usually paid by brokers and exchanges to provide liquidity to the market. That's what they do. Okay, so it's not like they are a wicked set of people that all they are concerned about is to fuck you up. Not exactly. Yeah, they can be very brutal a lot of times, but what they are essentially doing is that they get paid, okay, for them to provide liquidity. What is liquidity? Liquidity is just orders. Orders. That's what liquidity is. Okay. Um, when you are buying, Okay, the way futures, the way the forex market works, the financial market works is such that when you are buying, somebody has to sell. When you are selling, somebody has to buy. Now, when you want to buy and nobody is selling, what it means is that your order will not fill. Okay, if your order get filled, the um what's it called now? You won't be able to get the exact price you wanted. Okay, so you will see maybe you are looking at buying at, let's say, $24. Okay, you might end up buying at, let's say, 24.9 if there isn't enough liquidity in the market. So the market makers are actually people that are getting paid whenever their orders get filled. So exchanges, Binance and co, brokers, they pay them whenever their orders are filled. Now, when they place orders at a particular level, okay, and the order get filled, they want to ensure that they are not at any loss. Okay, so they've placed their order. Let's assume they place a buy order, huge order. Okay, huge order. Whenever their order get filled, they get paid by the exchange they are working with or by the broker they are working with. Okay, and since they've placed real orders, okay, they want to defend their position. They want to ensure that they are not at a loss. Okay, so assuming they want to drive price upward, okay, they've placed orders somewhere at the top. Okay, they've placed order at a particular level, limit order at a particular level. Their intent is for that order to get filled so that the exchange will pay them or the brokers they are working with would pay them. At the same time, they want to ensure that when price gets to the level they want it to get to, they are not at a loss. Okay, so if price should go beyond where they place their order, they want to try to push price down so that they can exit their position. All right, so if you look at this kilo now, this is where this is current, assuming this is current market price, this is where they want to place, they want to drive price to here. Okay, now because they are placing a huge amount of order, okay, for that, for price to go up, they have to push it. That means they have to buy for it to get here. So they buy here, huge order get activated here, price goes up. Okay, now there is also what you call um intermarkets, I've forgotten the name. Okay, IPDA, something like that. It's like an algorithm designed to present price. Okay, it's designed to present price. Okay, so it's such that whenever there is a lot of demand somewhere and the market is unable to fulfill that demand, maybe there isn't enough orders. Assuming I want to buy at this level, for example, I want to buy, there is a lot of orders, a lot of buy orders, but there isn't enough limit orders to fulfill the buy orders. Okay, so usually if there is a lot of limit orders somewhere around there, what the algorithm does is that it pushes price down so that those who were unable to buy somewhere around here can get a chance to buy. Okay, so because of the huge orders that started here and price goes up, not all the orders will get filled. Some of the orders will not get filled. And usually, the algorithm is designed in such a way that it pushes price down until everybody gets a fair chance at buying. Okay, so price goes up, huge order gets activated here. because the orders are huge, maybe assuming they are buy orders at this level, the orders get activated. They're buying. And remember, I told you that when you are buying, there must be a corresponding seller. Okay, so when price taps to this limit order that the market makers have placed somewhere here, because their orders are huge, not all the orders will get filled up. Some orders will get filled, but not all of them will get filled up. So price goes up impulsively. Okay, the algorithm will try to push price down back to that level so that those orders can get filled. Okay, but the market makers, because they've bought, their intent is to drive price up. They would not want price, they would not want the algorithm to drive price beyond this level, okay, where they bought. Okay, so as price is coming down, they will start placing huge orders that will drive price back up. Okay, so as price retraces down, as the algorithm pushes price down, they'll place huge orders before this level so that this low is protected. Okay, so they have buy orders here. Don't forget, the level where price retraces, buy orders was what pushed it up. Okay, so at this level is where they sell. They're going to sell here. They will sell some portions here. Price goes up again. Okay, remember they bought here again to protect their orders here. So there are some orders here, that's buy orders here. Price goes up again. They sell, retraces because they don't want price to get to this level. Okay, so they place buy orders again to push the price up. The algorithm pushes price down. They place buy orders to push the price up again. Okay, so this is essentially what happens. And when you look at market profile, when you look at market footprint, you can actually see how this is happening. Okay, you can see the charts, you can see how it is happening. So you can see where the big, large orders are being activated, where there is imbalances, when not all the orders at a particular level are being filled. You can see it, you can actually see it as it is playing out on market profile charts. You can see it. Okay, but you don't need to know how that works, but I'm just trying to explain the theory behind it so that um, you will have an idea. Okay, so that's what happens. Okay, at this level, just know that they are buying. At this level, they are selling. At this level, they are buying. At this level, they are selling. So you can see that now Can you still see my screen? I lost my connection for a minute. Okay, I think it has disconnected. Let me share again. Can you hear me?
Yes, I can hear you.
Okay, okay, great. And you can also see my screen. Okay.
Yes, yes.
All right. So that's like the theory behind this. Okay. What you just need to know is that in a bullish trend, um,
Yes.
okay, what you just need to know is that in a bullish trend, the lows, the major low that forms, okay, is usually protected. So protected. If price should retrace, that's where you are looking to buy. That's where you want to place your stop loss, so that price um, would not trade through them. Okay, until there is a change in trend. That's when. So at these levels, there are stop loss here, stop loss here, stop loss here, stop loss here, stop loss here for those that wants to short. Maybe retail traders that think that okay, price is coming down, then they want to enter at market price and then they place a stop loss at that level because they think that is the resistance and that price will not trade past it. Okay, so at this level, each time this price goes trades through this, okay, because there are sell stops. That's another reason why price retraces. Okay, price drives through it because there are sell stops at these highs. Okay, for retail traders that are looking to short the market. They want to short, okay? They want to short the market, so they place stops here. And when those stops get triggered, um, price retraces. Okay, aside from the fact that the algorithm drives price down so that those who are unable to buy um, can get another opportunity to buy. Okay, that's the way the algorithm is designed. Okay, interbank delivery algorithm (IPDA). Yeah. So that's the same thing that applies in a bearish trend. Okay, each low that forms in a bearish trend would be sacrificed as liquidity. So here orders, don't forget that whenever you hear liquidity, simply orders. It's simply where there are orders, either sell stops or buy stops or where there are limit orders. That's what liquidity is. Okay, so every high and low, just know that there is liquidity there. Every high and low you see on the chart, there is liquidity resting there. Liquidity here, liquidity here, liquidity here, liquidity here, liquidity here, and so on and so forth. So liquidity here at the top, liquidity at the bottom, okay, of the range. Every high, there is liquidity there. Every low, there is liquidity there. Okay, so when on this side, on the highs, what you have there are usually buy um buy stop, okay, buy stop, okay. Basically what it means here is that some people are looking to buy at this level, okay, and so that they won't have a loss, they place a stop loss. And don't forget that that stop loss is a kind of order, is a kind of limit order. So it's essentially an order. Okay, so when it gets filled, okay, price, once price triggers it, they sell and then price goes down. All right, that's basically the theory behind it. Okay, in summary, what you just need to know is that in a bullish trend, price is forming higher highs, higher lows, higher highs, higher lows. And the higher lows are protected because we want price to go up, we don't want price to come down. All right. And in a bearish trend, price is forming lower low, lower high, we want to go down, so the lows would be deferred, okay, and the highs will be protected. All right, and in a range, price is just moving, consolidating within an area. Okay, so if price is going to go down, the liquidity at the top will be swept. If price is going to go up, the liquidity at the bottom will be swept. Okay, and sometimes price will sweep both before it moves. Okay, sometimes will sweep both of them before it moves. Okay, so these lows, these highs, these lows in an uptrend are protected, the highs are targeted, they are weak, strong, weak, strong. Okay, so another way you can differentiate between protected or strong highs and low is that the job of every low in an uptrend, okay, is to take out the high, okay, to break the high. That's the job of every low that forms in an uptrend. The job of this low is to take out this high, that is trade above this high. When it does that, it is a strong low. Okay, when it breaks structure, when it breaks market structure, okay, this is market structure. Okay, when it breaks it is a strong low, a strong higher low. Okay, and the job of every low is to take out a high. Okay, the job of this low is to take out this high, the high that forms this high. Okay, price is going up, it failed to do that job. Same way here, the job of this high is to take out this low. It failed to do that. Okay, because it failed to do that, this high would be called a weak high. This low does its own job, broke above, this low becomes a strong low. Okay, just see it this way, the job of this low is to take out the previous high. Okay, don't forget, price is going up, price gets to this level, retraces. The job of this low is to take out this high. The job of this high is to take out this low. But this high did not take out this low. Okay, so this high becomes a weak low, a weak high, and as a result, price will trade above it. Okay, you can see that price traded above it. Okay, and the job of this low as well is to take out this high. It does that successfully, so this low is a strong low. The job of this high is to take out the previously formed low. Okay, don't forget, before this high formed, this low formed. The job of this high actually is to take out this low, that is to form something like this. Let me, where's my arrow? Is for it to actually come like this and trade below this low that is here, trade below it. But it didn't do that. It reverses before it does that. So this high becomes a weak high. Okay, so as a result, it will be targeted. Price will trade above it. Okay, that's the whole concept of strong highs and weak highs and weak lows and all of that. So usually when you are trading and you're looking for a target, you want to use weak highs and lows as your target. Okay, because you know that price will trade back it and your um, take profit will be triggered. Okay, because you can be sure that price will trade past it. Okay, and if you want to place your stop loss, you want to use a strong low or a strong high as your stop loss, because it is assumed that price will not trade past them. Okay, that's it. Now let me explain the concept of um, what was it called now? The concept of the fractal nature of price. Yeah, fractal nature of price. Let me pull out these charts. Okay. Okay. Let me admit. Okay, so the fractal nature of price. What this essentially means is that when you look at okay, a swing is basically a leg. When price prints a leg, the distance between a higher high and a higher low, for example, that's a swing. So when price makes a swing on higher time frame, okay, what happens on the lower time frame is a replica of what happens on the lower time frame. Okay, what it means is that when you take this one leg on higher, let's say 4 hour time frame, okay, just one leg, what you see is one leg. But when you look at the lower time frame, let's say 15 minutes, what you see in that one leg is series of higher highs and higher lows. Okay, so let me show you an example. Um, let me show you an example on BTC. So if we look at, let's say, the daily time frame, for example, okay, if we look at the daily time frame, we'll see from here, that this is essentially one leg. This is one swing on the daily time frame, one swing. Okay, this is one swing. All right, one swing before we're now forming a higher. This is like one swing. But when you go to the 4 hour time frame, what you see is series of higher highs and lower lows. Okay, you can see higher high, I mean lower high, rather lower high, um lower low, lower high, lower low, lower high, lower low. Okay, so that's basically what the fractal nature of price means. Okay, so if there is going to be a shift in market structure, you would have seen it on the lower time frame. Okay, that's basically what that means. um, so when you see a swing, okay, when you go to the lower time frame, what you see is series of higher highs and higher lows. Okay, so at the level where you think price is going to retrace, okay, on the lower time frame, you are going to see a market structure shift on the lower time frame before price now makes another leg up. So usually at this level, you want to look for long. At this level, you want to look for short. At this level, you want to look for long. At this level, you want to look for short. You would see your confirmation in lower time frame. You see a shift in market structure on the lower time frame. All right. So once you see a shift on the lower time frame, you have a higher probability that the higher time frame would play out. Okay, let me show you another example on BTC daily time frame. If you look at this on the daily, okay, this is BTC all-time high. Okay, when price formed this, from here you can, from this level, okay, from this level you can actually see at this level here, when you narrow down to the lower time frame, at this level you would see a market structure shift. Okay, you would see a market structure shift at this level. Okay, somewhere around there. If you narrow down to the lower time frame, I don't want to narrow down that. If you check the lower time frame, you see a market structure shift. Let's say 5 minutes, 15 minutes, and so on. Okay, so of course at this level you don't know if price is going to like resume a bearish trend yet until it breaks below the previous low. Okay, but what you are just looking to do is to counter trend. Like you've seen on the lower time frame, it has broken. Once price breaks above the previous higher high. I told you that there is always a retracement usually. Okay, so usually you see a retracement. Okay, let me show you examples here. You can see from here that whenever price trades up, breaks above this level, you want to start looking for a market structure shift on lower time frame so that you can play a counter trend. You can play shorts. Okay, this is a high. Price trades above it, retraces. Okay, as it is retracing and is getting to the previous origin, the origin of the previous um, high, previous low, rather, the low that formed the previous high. Okay, you want to start looking for a market structure shift. Okay, at this level, when you narrow down to the lower time frame, 15 minutes, 5 minutes, you would see a market structure shift to the upside. Okay, and you could take a long there. And when you take a long, usually what you want to target is the previous high, this level here. Okay, that's where you want to take your profits. Okay, you don't know if price is going to continue to trade up. You don't want to be greedy. Okay, if you want to catch the move, what you can probably do is to um, take some position here, maybe take like 85% position and leave the rest if you think that price is going to enter discovery, and then if you think that what you are trading, the token is going to enter price discovery and it's still going to go higher, you can take like majority of your position when it trades past this level, and you leave the rest, maybe like 15% or 10%, just in case, and then you move your stop loss to break even. Moving your stop loss to break even means you are moving your stop loss to your entry point, so that if price should come back against you and takes you out, you will not be at any loss. Okay, that's that. So price trades up, retraces at this level. When you go to the lower time frame, you would see a market structure shift. Okay, so there you want to enter a long, you want to target this high, okay, and take profits. All right. And you can see in this case now, assuming you didn't take profits and you are still waiting that, oh, maybe price will still go higher, like many people were predicting 100k BTC last year. Okay, and you are waiting, you didn't take profit, you are still waiting, you can see that price would have gone back and it would have taken you out here. All right, so each time a swing is formed, there is usually a retracement. Okay, so ideally you would expect that when this retracement is happening at this level, there should be a bounce. Okay, but the bounce did not happen. Instead, it broke below the protected um the strong low here. Okay, this is a higher low. Okay, but it's a low, of course. Okay, so it traded below it. It is meant to be protected. It is a strong low. Why? Because it broke above the previous high. The job is to take out the high. The job of a low is to take out the high. The job of a high is to take out a low. So the job of this low here is to take out the previous high. It has done that successfully. So it is strong. It is meant to be protected. Price is not supposed to trade past it, but price traded past it. And as a result, we call this market structure shift, MSS. Okay, so smart money concept traders, they call it um, change of character, or CHOCH. But me, I just prefer to call it MSS. I mean, simpler, and it makes more sense. There's a shift of the market to a different trend. Okay, so this is a market structure shift. Now, when market structure shift happens, you would expect that price would trade back up. Okay, either to this level, that's where you'll be looking to enter. This level here is where you would want to enter, or this level. Okay, the origin of the impulse that broke market structure, either this level or this level, that's where you'll be looking to enter. Okay, now this high would become a strong high. All right, because the job of this high is to break below this low, and it has done that. So this high becomes protected. Okay, that's where you want to place your stop loss. You want to place your entry somewhere here, somewhere here. In this case, you would not have been picked. Okay, so sometimes the retracement might not happen. Okay, the retracement here was short because supply is strong. Okay, the bearish trend is very strong. The retracement did not happen. Okay, but what followed after is a supply chain. Okay, supply chain is basically okay, let me explain something to you. Let me just quickly explain something about demand and supply quickly. Okay, supply is essentially where people are selling. Okay, that's where people are selling. Demand is where people are buying. Okay, so when price comes down, forms a low, goes up, forms a high, comes down, forms a low. Okay, this level where the price was pushed down becomes the supply. Okay, that level becomes the supply. All right, this level here becomes the supply. All right, and when price trades there again, you expect that it is going to push back price back down. Why? Because that is where they bought, that is where they sold. Okay, they're in a short position now. Okay, so they are going to defend their position. When price comes back there, you expect that there will be a rejection. This usually is what some people call order blocks. Okay, order blocks are basically just supply and demand levels. Okay, that's it. Okay, it's just supply and demand. All right, so let me go back to that. And the level where they are buying, okay, this level, for example, the level here, this is where they bought. Okay, this is where they bought when price went up. They bought at this level and price went up. So when price comes back again, you would expect that that level would hold. Okay, if that level does not hold, that's what you call a market structure um shifts or a market structure break. Okay, market structure shifts is basically market structure break that is against the trend. Okay, in a bearish trend, market structure break will be to the downside. Okay, like this, for example, this is a bearish trend. Market structure break is to the downside. Okay, now when market structure break like this one is opposite the direction of the trend, that is another definition of market structure shifts. Okay, so market structure shifts is basically market structure break that is opposite to the direction of the current trend. All right, so using the BTC example again, you can see price is going up. Market structure break should be to the upside. Market structure break should be to the upside. You can see there is no break to the downside. This low is protected, this low is protected, this low is protected. No break to the downside. So the first break to the downside is market structure shifts. Okay, so price retraces, um, and then there is a small demand, there is a small supply here. You can see that price went up at this level. Price went up and then they sold and pushed the price down. You can see this candle that went up. There was a buying there. That's why it went up, obviously. Okay. So that's a level that's going to be your supply zone. Okay. So you expect that when price comes there, they would want to defend their position. Okay, they would want to defend their position and they want to push price down. Okay, this is the level where demand, this is where they bought here. Okay, so at this level they will be looking to here. So this is going to be the level where they are buying, but unfortunately price drove below it. Okay, so that is a failure of demand. Supply up, demand down. So this is a failure of demand, but eventually they try to push it up again. Okay, so that they can exit their position. Okay, now when this happens, there is a new supply here. That is the level where they are selling again to push the price down. Okay, so this level, that's where they are selling again. They sold, they push the price down again. Supply, I mean demand failed. Okay, remember this is the level where they bought here to push the price to this level. Okay, ideally you expect that they will protect their position. Of course, no, the market makers are always like, they're always trying to fight with each other because it's a matter of who wins or who is willing to surrender. Okay, so we can see from here that market makers are bearish, they are winning. First time they push the price down, these ones they couldn't protect their position here. Okay, so that's a failure of demand. Okay, that's a failure of demand. Price goes up, supply overcome demand, push the price down. So we see a supply chain. That means supply is in control. So we see a supply chain building up. All right. So once you confirm, like the first time, second time, demand could not overcome. Okay, so you can almost be certain that okay, a bearish trend is about to happen, or we are now in a bearish trend. Aside from this market structure, so that's additional confirmation that there is going to be a downtrend. All right, so you want to enter here when price drove below this level and came back again. You want to enter at this level, okay, and you want to target this low, okay, this low. That's the low you want to target. All right. So that's basically all you need to know about market structure shift for now. The other criterias, okay, the other criterias, um, market structure shift needs to happen at important levels, okay, at your higher time frame POIs. Okay, let me show you examples here since we have a price history. All right, let me mark out the supply zone. I'm still going to do an explanation, a detailed explanation of demand and supplies, especially how you mark out your level, bodies, wicks, and all of that, where you know how you know where to mark out. Okay, I'll still do a tutorial on that. All right. That's what I assume how to mark out the supply zones. Okay, at this level. Don't forget, I told you that the supply zone is the level where they are selling. So where price was pushed down, that is your supply zone. Okay, so let me start from here. This would be my supply zone. That's where price was pushed down. Okay, so that is my supply zone. Okay, at this level too, there was buying power at this level. Okay, at this level, price was pushed up. This is supply zone. That's where price was pushed up. Okay, so at this level again, price was pushed down. That is my supply zone again. So I expect that in a bearish trend, you can see that that was literally what pushed price down. Because that's where some market makers, that's where they took their short position. So they want to protect their position. Okay, so when price is coming up, they want to protect their position so that they can exit in profits. They want to push the price down. Okay, so that's supply zone here and here as well. This is another supply zone. This is where they push the price down. Okay, that's another supply zone. here is where they push the price down, this level and this level as well. So that's your supply zone. Okay, I'm still going to do a tutorial on how you mark out supply and demand zone, but I'm just so that you understand what I'm about to explain next. This is a supply zone. Okay, so there are ways you know whether a supply zone will hold or not, whether a demand zone will hold or not. Okay, there are some rules you can follow to at least try to improve your accuracy. Okay, not absolute, but just to improve your accuracy. Okay, so um let's go to the 4 hour time frame. Okay, this is daily time frame. I've marked out demand and supply zone. Okay, for a market structure shift to be valid, it must be happening within a higher time frame supply or demand zone. Okay, now higher time frame is relative. Okay, if I'm trading intraday, I'm trading 15 minutes, 5 minutes, 3 minutes charts. My higher time frame will be 15 minutes. My lower time frame will be 1 minute, 5 minutes, 15 minutes. Okay, if I'm trading daily charts, my lower time frame will be like 4 hour time frame, or let's say 15 minutes time frame. Okay, so I want to look for market structure shifts on the 4 hour time frame. Okay, if I'm trading the daily charts, I want to look for market structure shifts on the 4 hour time frame. Okay, if I'm trading the 4 hour chart, I want to look for market structure shifts on the 15 minute chart, or let's say 5 minutes chart. Okay, and that market structure shift has to happen on my previously marked out higher time frame supply or demand zone. Okay. Okay, so if you go to the 4 hour time frame, look at look at this is the daily supply zone that we marked out. Okay, this is the daily supply zone we marked out. Okay, um things are not very vivid on the, you can see it, I can see it, I can see the price is trading higher high, higher low, 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 and so on and so forth. And price came here, higher high, higher low. It was supposed to make a higher high, but it failed. Okay, so here supply failed. Okay, I mean supply held, rather supply held. Demand was unable to push price above the previous high, and then it traded down below the previous low. So this is your market structure shift. It has to happen at your previously marked. You can see here, we've marked this out previously. Okay, we've marked this out. This is where price was pushed down. So we expect that when price come there, it should drop. But it didn't drop. So we look at the lower time frame. If we say market structure shift, there's no market structure shift. You don't do anything. You move on to the next higher time frame supply zone. This is the next one. Here we see a market structure shift to the downside, and then usually you see retracement back to the origin of the impulse. Okay, broke below. This is the origin. Okay, this is the origin. Okay, this is the where you would want to enter your short position. And then where do you target? Because you are trading on the daily time frame. Okay, you can see you want to target, here, this level, and this level, this level, or this level. Okay, so at this level, you check to see if you see a market structure shift. Okay, don't forget, let me mark this out so that you see it. So this is a higher time frame demand zone. So when price taps into this demand zone, you are going to narrow down to 4 hour, 15 minutes, 4 hour time frame, and 15-minute time frame. You want to check if you see a market structure shift. Okay, then you want to take a long and you target this high. Possibly this one, since this zone had already been defined. Okay, so you want to target this low. Okay, so if we should see a pump next, okay, if we should see a pump, price will most likely get to the 50K level before it drops, since this zone had already been mitigated. Okay, you call it mitigation. I'll still explain all of that, but I just want to touch it a little bit now so that you understand what I'm trying to explain about market structure shifts, about the criterias for market structure shifts. It must be within a higher time frame supply or demand zone. Okay, your POIs. It must happen within them. Any market structure shift that happens outside of that, you ignore. Okay, you ignore them. If it is not happening within a higher time frame, demand or supply zone, you ignore it. Okay, you ignore it. All right. So that's the first rule. The second rule is that um, it must take liquidity before it breaks it. Okay. So let me go to the BTC, for example. Don't forget I said liquidity are basically just orders. Okay, this is like I told you, there is liquidity resting on top of every high and below every low. Orders are resting there. Okay, so before it breaks structure, liquidity must have been taken. All right, you can see this price traded above it. That's a liquidity sweep. Okay, or SFP. SFP is same as liquidity sweep. Okay, so price trades above it. It could be an SFP, it could just be a sweep, whichever one. Okay, and then broke below this. Assuming price just came like this, no sweep, it didn't trade past this, there's no liquidity sweep, and then broke below. I would not consider this a valid market structure shift. Some people, some traders will consider it as a valid MSS, but except it, you are just trying to like refine your you are trying to improve your accuracy. If it takes this, takes out this high, you know that this high is going to be protected. Assuming it didn't take it out, even though it's broke structure, and this is a strong this is a strong high, you expect that if price to trade past it, it should hold. Okay, it should hold. But because it didn't take liquidity, market makers would not, why would they want to protect position here since it didn't take liquidity? Okay, so those that shorted here, their position is still intact. So the probability of this low holding, even though it is a strong, of this high holding, even though it is a strong high that broke structure, is lower because price could trade past it to take liquidity before it drops. Okay, because price moves from liquidity to liquidity. Okay, that's it. That's what you should know. Price moves from liquidity to liquidity. So if it doesn't take liquidity, that is trades above a high before it broke structure, then that would not be considered a valid market structure shift. I do not consider it valid market structure shifts. Right? So um let me show you another example here. Okay, let me go to the 4-hour time frame. This one, for example, before this low was broken, you can see that price has taken liquidity here, here. Show you clearly. You can see price has taken liquidity here. The liquidity residing at the top of this, the liquidity here and here. Price has taken it before it broke structure. So you want to ask yourself, before it broke structure, did it take liquidity? All right, did it take liquidity before? Let me show you. This is a very good example here. You can see there is liquidity here. There's liquidity here. Here, basically the whole of this level here. Okay, there's liquidity resting here. So price came down, took liquidity, and then broke structure. So you expect that there will be a retracement back to the origin of the impulse. Okay, at this level, your stop loss will be here. Okay, your stop loss will be at this level. Okay, and your order can be anywhere below the MSS level depending on how. There are ways you can look for pinpoint entries. Okay, you just narrow down to the lower time frame, 15 minutes, and you start looking for when you see a market structure shift to the upside. Okay, then you wait for retracements and you allow price to go, right? So you can either mark this. No, this is the origin of the impulse. This is the first candle. Okay, so you can either place your entry at the top of it, at the middle of it, or at the middle of it. That will be equilibrium. Okay, so just draw a fib. That will be equilibrium. Okay, that's fair value price. Okay, that's the equilibrium of the supply zone. Okay, a lot of times I like to enter at equilibrium instead of at the top because that would mean that my RR will be higher. Okay, and you target the previous high. First take profits somewhere here, next take profits somewhere here. Okay, and you maybe leave the rest like 10% or even 5% um, to the next demand zone, or you just leave it depending on um, your risk appetite and your greed level. All right, so that's how you enter position based on market structure shifts. Okay, this is another example of market structure shifts here on BTC. Okay, the first question you can see price is coming down. This is the one I was showing you on the higher. You can see it's clearer on the lower time frame. Okay, price is trading up, makes a high, makes a low, sweeps liquidity. Okay, like I said, there's liquidity resting on the high. So it took liquidity and then broke below here. Once that break happens, you start anticipating a pullback to the origin of the impulse. Ideally, you want to mark there are rules you want to follow. I will still expatiate on that later when I start talking about POIs. Okay, I'll still do a detailed explanation of POIs, how you mark your level, how you mark the wick, and all of that. Um, you see, sometimes I use the wick, sometimes I use the full body, sometimes I use the middle of the wick. Okay, it basically depends on um, a lot of factors. There are different. I will say explain that, but for now, just know that it is the full body. Okay, when you mark out the candle, that's the first candle before the move. Okay, that's what you call that block. Oh, it's just supply zone. I don't use other block because I just see them as supply and demand zones, and but that's what some people call that blocks. Okay, um, the first week. Okay, you can place your order here or you use the midline. Okay, when you draw a fib from the top of the week to the bottom, okay, that's where you place your order, either here or here. Normally, when I'm entering first, I like to use the lower portion of the supply zone, the lower portion when price is tapping first time. But when prices come to that level the second time and it hasn't touched the fair value price, which is the equilibrium of supply, I like to use the midline. Okay, and my stop loss at the top here. For example, this trade that was coming here, you can see that it dropped from equilibrium, straight down from equilibrium. I'm not supposed to explain this yet, but I'm trying to so that you understand the logic behind my trades when you see me when I make my entries and all of that, so that you'll be able to make your entries yourself as well. All right. So usually price came there, the demand zone held, and price dropped from the equilibrium of the supply zone. Pam. Okay. Same thing here. Um, if you look at the left, okay, you can see price came, price dropped, price took liquidity here. This is liquidity. Okay, took liquidity here before it broke structure. Okay, so that's the market structure shift. So once market structure shift happens, you wait for retracement to this level. Okay, to this level. In this case now, price did not get there. So we believe that if price should come to this level again, we should get a bounce. Okay, here price did not come because of the imbalance here. Okay, imbalance. The reason why pricing gets here is because of this imbalance. So usually when you see an imbalance, just use the candle before the imbalance, especially when price is coming the first time. Just use the candle before the imbalance. You can see from here, it would have been peaked. Okay, imbalance is basically okay, I'm already beginning to explain too much. Let's take it little step by step, okay? But just see imbalance as places where you have huge orders. When price is going up and you see Marubuzo candles like this, candles that doesn't have wicks, okay? Candles that doesn't have long wicks, short wicks like this. Okay, this is Marubuzo candle. Once you see that, usually imbalance means there is a lot of um, demand or supply orders. Okay, a lot of buy or sell orders. The sell orders or buy orders are so huge that some sell orders were not filled. Okay, so when that happens, price is moving rapidly that some orders did not get filled. Okay, so usually when price returns to that imbalance, you will see an immediate sharp movement in the opposite direction. Okay, I'm still going to talk about price imbalance, price inefficiencies. I'm still going to do a different explanation on that. Okay, but for now, just see it as where you have a lot of orders that haven't been filled. Okay, so the algorithm drives price towards the imbalance so that it will get filled. Okay, there is also imbalance here. Okay, and price expands up to fill it up. So market structure shifts. Liquidity sweep, first and foremost, it is happening at a higher time frame demand zone. Let me show you the zone here. Okay, this is the zone here. Okay, this is the zone. On 12-hour, the zone will be somewhere here. Okay, so it is happening at a higher time frame demand zone when price is dropping, supply zone when price is going up. All right, so it has tapped into the demand zone and then swept liquidity. Don't forget that there is also liquidity here. All of these are liquidity. Liquidity, 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 liquidity. Okay, so liquidity, then break structure. Okay, so those are the rules you want to look at. Okay, if not, you see market structure shifts and you think that okay, price is going to retrace and then you will see any retracement to get stopped out. Okay, so these are the rules that can improve your accuracy. The first one, it must be within a higher time frame supply or demand zone. The second one, price must have swept liquidity before the market structure shift happens. Okay, so those are the two important rules you want to follow. All right, I think
Please,
that
please, can you repeat those rules?
okay. The first one is that the market structure shift must be within a higher time frame supply or demand zone. The second one is that before the market structure shift happens, price must have taken liquidity on the left. Okay, so this is liquidity here. This is liquidity. This is liquidity. So price must have swept liquidity before it breaks structure to the upside. All right, so that's the second rule you want to follow. The third rule you want to follow is preferably there should be a fair value gap or price inefficiency. Okay. Um, After the market structure shifts. Okay, like when market structure shifts happened, there should be price inefficiency that precedes it. Like this one now, you can see um, the fair value gap here. Okay, you can see the fair value gap. Let me quickly do a quick explanation of fair value gap or price inefficiency. Assuming you have two candles, okay, you have two candles like this, or let's say you have three candles. All the candles, they have wicks. Okay. This is how a normal candle would be. Okay, the wicks are connected. Okay, the wicks are connecting with one another. Okay, so in situations where the wicks are not connecting, they are not interconnecting. Okay, maybe something like this. You are going to have a gap somewhere here like this. Okay, so this gap between the two wicks is a fair value gap. Those gaps, there's usually a lot of orders. Assuming this is a bearish trend, this gap will have a lot of orders. Okay, there, a lot of orders. So when price taps there, okay, those orders get activated and you see that price would move up. Okay, so this is an example here. You can see this is a gap here. That's a gap. This is another gap. The wicks are not connecting. The wicks of the candle are not connecting. Okay, this is another gap here. Okay, so when the market structure shift happens, preceding the market structure shifts, you want to see a fair value gap. Okay, it shows that the impulse, the bullish impulse is strong. Okay, you want to see a fair value gap. It's not the time you see fair value gap is not the time, but when you say fair value gap, you have it increases your accuracy. Okay, it increases your accuracy. You can see from here as well, when it broke structure, you can see the fair value gap here. Here, you can see another fair value gap here. You can see the space between this wick, this candle, and this candle. I'm saying to explain fair value gap, price inefficiencies, and all of that, but that's basically what you should know about fair value gap for now. You can see this is another fair value gap here. Here. Okay, so the wicks are not joining each other. Okay, every other places you can see the wicks are joining each other. Okay. Here as well, before this market structure shifts, when you go to the lower time frame, you would see it. You see it there. This is another example. You can see those are examples. Okay, so those are the rules. Those are the three important rules you want to follow. Okay, there is another rule of inducement, but because I haven't explained inducement, I haven't explained liquidity concepts. Um, just take those three rules for now. Okay, the first one is must market structure shifts must be at a higher time frame, supply or demand zone. Um, price must have swept liquidity on the left before the market structure shifts. Two, um, fair value gap should precede your um, you should see a fair value gap or price inefficiency before the market structure shifts. It increases your accuracy. Okay, it increases your accuracy. That's basically what it does. Sometimes you won't see fair value gap. Um, a lot of times, the high probability setup you see fair value gap because it indicates that that trend, that shift in market structure is strong. Okay, it's strong. So when price retraces, you expect that the price is going to go up. And when you see fair value gaps, like I said, it indicates that the trend is strong. So sometimes when the retracement is happening, it will not go back to the origin of the impulse. Okay, so in situations like that, you want to use the first candle that precedes the fair value gap. Let me see if I can still see more examples. Um, so I can't find examples here, but I hope you understand my explanation on market structure. Hope it's clear now. Um, I don't know if you have questions. If you have any question, you can. Okay, somebody is asking if it happens at a higher time frame support and resistance. Okay, this is it. If you are trading smart concepts, there is nothing like support and resistance. All right, if you are trading smart money concepts, there is no such thing as support and resistance. Okay, you only know supply and resistance. I mean supply and demand zones. Okay, this is another example of market structure shifts. You can see, let's look at all the, this one now, for example, is not, there is no higher time frame supply or demand zone, nothing like that. Okay, but there are ways, when price is in market discovery, there are ways you can know where price is likely going to retrace from. There are ways you can know using fib. Okay, using fib. If I draw a fib from the swing that preceded it from here to here, let me use um, let me draw it from here to here. So let me use this swing low. Let me use this swing low. Okay, this is where the bullish trend started. From here, I draw it to this place. Okay, usually you want to start looking for possible retracements or shorts anywhere above this level, anywhere above the zero level. Okay, price has come here, retrace anywhere. You can see the zero level ties with the previous swing high. So anywhere above this, you want to start looking for a market structure shift. So at this level, you try to check, is there market structure shift? At this level, is there market structure shift? At this level, is there market structure shift? Okay. Um. So if 618 is golden pocket. Okay, 618 is what you call golden pocket. Fibonacci ratio. Most of the time, retracements used to happen from 0.618. So if you are trading a token that doesn't have history, like it doesn't have price history, it's in price discovery, so you can't really mark out higher time frames, supply and demand zones. You can't really mark them out. Okay, you can use fib to know where there is likely going to be a reversal. Okay, and you start looking for market structure shifts at that level. You can see this is BTC last year before that dump that happened. You can see the market structure shifts that happened. Price is higher high, higher low, higher high, higher low, higher high, higher low, higher high. So supposed to form a higher low. Okay, you can see this the demand to supply flip that happened here. Okay, price bounced from the demand zone, went up, supply field, and then there was a market structure shift here. Okay, so market structure shift. Okay, and you can see there is fair value gap here. You can see fair value gap here. Okay, so that's the gap between the wick of this candle and this. Let me see if I can zoom in so that you see it clearly. Okay, you can see that. Let me delete the fibs. You can see every other candle, the wicks are connecting. Okay, the wick of this candle is connecting the wick to the wick of this candle. Okay, but this candle, this first candle here, the wick is not connecting to this candle. Okay, so there is a gap there. Okay, that gap is what you call fair value gap. Okay, so let me get out. Okay, so that gap, because 2 weeks are not connecting. Ideally, in every, you can see all through here, the wicks are connecting. Okay, the wicks are connecting. Okay, there is no gap here. There is a gap here. Okay, you can see the gap that happened. And I told that when you see fair value gap, ideally, instead of using the first, um, ideally when you are marking supply and demand zone, you want to use the first candle that preceded the impulse that broke the market structure. So ideally, you want to use this. Okay, ideally, you want to use that as your supply zone. Okay, come. Okay, so you want to use that as your supply zone. But I told you that when you see a fair value gap, it's just best you use the first candle the um before the fair value gap, which in this case will be this one. Okay, so that will be your supply zone. That will be your POI. You can see that price tapped into it and then drop. That would have been an absolutely perfect pinpoint entry. You can see price tapped it and then dropped. Okay. Um, so it is at 618 Fibonacci ratio, that's golden pocket. That's usually where you would see retracements. Okay, once it is at 618 or a little above 618, you most likely see a retracement from there. Okay, look at this for example. If I draw, as I'm anticipating a retracement from here, and I draw my fib from here to here. Okay, I'm anticipating a retracement. Okay, let me use this. Let me use this. Price has traveled from here to here. Okay, so I'm looking for where to buy if there is a retracement. Okay, usually when price trades below 0.5, okay, 0.5 is not included here now. Let me add it. Anywhere below 0.5, you want to look for longs. I thought I just enabled 0.5. Oh, okay. The color is different. And then how you can possibly know your demand or supply zones and all of that. So anywhere below the 0.5 level is where you want to start looking for short. If I should go to the lower time frame, okay, if I should narrow down to 15 minutes, 5, you will see a market structure shift at this level before the price went up. Okay, and you want to target this level. I want to target this level. Okay, you can see price came into the 0.618 and then went up again. So you could take a long here and you want to target this level. Okay, but fortunately in this case, it would not have reached your take profit. That's why it's important to always take profits incrementally, especially when a high is broken. When the high is broken, you want to take profit. Of course, you would have known too from here that there was a market structure shift to the upside. So obviously, you are playing a counter trend, right? So you want to take profit early, all right? Since you are expecting to take a short at this level because you understand what is actually going on. All right, so you can see that this meets all the criteria. It has taken the liquidity here before it broke market structure to the downside. Liquidity on the left before it broke market structure. There is fair value gap. It is happening at a POI, point of interest. Okay, point of interest does not necessarily have to be supply and demand zones alone. It can also be FYB levels. Okay, FYB levels, FIB levels, Fibonacci ratio levels, especially anywhere above 6.18 or 0.5. All right. Okay, let me show you more examples of how you could use FYBs to determine your reversal levels. Okay, for example, here, price traded from here to here. Okay, so you draw your fib levels from here to here. And you are looking for where you should potentially be looking for a market structure shift. You can see that price tapped above 0.5 into 6.18 and dropped. If you go to the lower time frame, you would actually see a market structure shift. I can see it even from here. Okay, I can see the market structure shift even from there. Price took liquidity from this high, broke structure, this low. I can identify it looking at it from here. It's not very obvious, but when you go to lower time frame, you see it more clearly. All right, this is a market structure shift. Then price traces back and then drops. Okay, so you want to enter at the retracement and then you target, you use this high as your um, stop loss and then you target this low depending on if you are playing intraday or daily. On daily, you can see that this is the low on the daily. So you target that low on the daily. Okay, you can see that this shift that happened here also happened on the daily. Okay, this is daily. This is daily. So you target the low, the next major low. Okay, you know that a bearish trend has happened and you have series of higher highs and higher lows and higher highs and higher lows and so on and so forth. Right? This is another example. of market structure shifts that preceded this uptrend here. Okay, this uptrend. Okay, you can see price took liquidity. Don't forget I said price has to take liquidity. Price took liquidity and broke structure. Supply to demand flip happened here. Supply reacted but failed to take out this low. Demand took over and broke structure. You can see it broke structure. So usually price will return back to the origin of the impulse. So this become an inducement. Price return back to the origin of the impulse, and then you place your usually you take the wick. Okay, I'm already giving you some of the criteria on how you draw your POI. In this case, I would have used the wick because the wick is more than the body. So when the wick is more than the body, you want to use um, place your order at the top here or at the midline. Okay, you can see the zone had been touched before. So in this case, I would have used the midline. Okay, and your stop loss below the wick. Okay, and you target the next high, this here. Okay, or this. Okay, depending on how conservative you are, you just take profits along the line, right? Okay, so that's it. Um, I don't know if there's any other question.
I have a question on the second rule where
Okay.
you said before the market structure shift happens, price must assert liquidity on the left side.
Yes.
That statement, that left side is what I don't understand about that.
Okay. Look at it. Look at this example. For example, look at this. Before this market structure shift happened, okay.
Okay.
Look at your left. Where do you have liquidity? Here. Like I told
Yes.
you, there is liquidity on every high and every low.
Yes.
Okay. Look to the left before the market structure shifts. Price traded above this level and took out the liquidity. Okay. You can
Okay.
see price took the liquidity that is resting here before it
Okay.
broke this low. Okay, let me show you more examples. This is your left before the break of structure. Price traded above this level.
Okay.
Okay, took liquidity before it broke structure. So that's pretty much what I mean.
Okay. So and it must happen on the lower time frame after
Yeah, it depends on where
at,
you are trading.
at your
If
as in on the higher
if
time frame.
assuming this is it, if assuming you are trading the higher time frame, like if you are trading daily, you want to look for market structure shifts on 4 hour or 15 minutes or 1 hour. Okay, if you are trading on 4 hour time frame, you want to look for market structure shifts on 15 minutes. Ideally,
I
if
think
you are trading
you do trade on
intraday,
4 hours time frame.
you say,
I said I think you do trade on 4 hours time frame.
show me. I mostly trade on 15 minutes. Okay, I like to enter
So
quick and exit quick. So I will look for market structure shifts on
one
the
minute or 5 minutes.
1 minute, 5 minutes time frame.
Okay.
Okay,
Yeah, I
so
understand. Thank
that's
you.
that's that's it. I
Sorry,
don't know if
please,
there's
I
any
have a
other question.
question. Please, are
Okay,
you going to give us, are you going to tell us how to set up our Fibonacci's?
okay. Let me open a screenshot so that you see different. I used three different ones. Okay, I created a template that I use. I use the one if I want to make an entry. I don't really use it to make an entry. I only use it to like, okay, have like, where do I expect that price may get to, or where do I expect that price may stop from. For example, Luna, where's Luna? Let me show you an example on Luna. Okay, so the last lunar retracement, price traded from here to here, broke the low by expecting a retracement. I will show you, maybe I'll screenshot it and just send it to the group. So if I want to look for where I could possibly look for market structure shifts, I use entry fib. Okay. So when price trades below 0.5, okay, that's why I start looking for. You can see price came here, 0.618, 0.702, 0.786. It's usually within these three most times. It could go below, it could go below, but anywhere below 0.5, that's where you want to start looking for market structure shifts. You can see from here, market structure shifts happened here on the daily. Okay, you can see before the market structure shifts, price took liquidity from this low. All right, after market structure shifts, like I said, you see retracements. If you see a retracement, then how do you determine your profit? You can also use fib to determine where you can possibly take profits. Okay, so you can take profits at this level, at this level, or at this level. Okay. Okay, let me screenshot this so that you can. These are my levels. I would send the screenshot to the group page so you can.
Thank you.
I will send to the group page later. Don't know if there's any other question.
I have something to say. I think
Okay, somebody
for
is
us to
asking
okay,
about trend line liquidity. Okay, let me use this to explain. Trend line liquidity is basically when you have a trend line, okay, like this. When you have series of higher highs, higher lows, higher highs, higher lows, remember I told you that on every high and on every low there is liquidity residing there. Okay, so there's liquidity here. Okay, so this forms a kind of trend line. Okay, it forms a trend line, and the liquidity resting there, all the liquidity resting there is what we call a trend line liquidity. So usually when the trend reverses, price is going to take out all the liquidity. It's going to take out the trend line liquidity before, and once it takes them out, you most likely see a retracement. Like the trend will most likely reverse and start taking the liquidity back again. Like that's essentially what you are seeing currently on BTC. Where is BTC? If you go to here, when price was going up, you can see that price was forming higher highs and higher lows. So all these higher highs and higher lows are basically liquidity. All right, those are liquidity. Okay, everything here, liquidity. Okay, so you expect that once the trend reverses, it's going to take out all those liquidity. Okay, that's what I call a trend line liquidity. Any more question? All right. So
Hello?
call it a day from
Can, can,
here.
can, can I say something before you call it a day?
Okay, okay. I'll with you.
I think I think anytime you are looking at a particular sort of on any pairs of coin, you can just tell
Okay.
us to to work on it in order to build our
Okay.
confidence towards
Great.
this. So we can send it to the group, you can check it and tell us if we've done well. So in order to build the confidence to do more and to also take trades on our own
Great.
when the
Great.
class
It's a
is
great idea. I will look to start doing that. Thanks for the suggestion.
Thank you. I enjoyed the class. Thank you so
Uh,
much.
you're
May the
welcome.
Lord bless you.
Amen. Amen. All right, guys. I'm going to screenshot the fib levels and send it to the group page. Enjoy the rest of the night.
thank you, God bless you, thank you. This
Yeah.
is great.
Bye.
Thank you so much.